go ahead and start. I want to say just actually one thing about Tom Russo that I hope you noticed. He talked a lot about brands, but when he talked about value added, did it have anything to do with brands at all? And the answer is no. You are going to come across a lot of people who intuitively understand the structure of value creation in industries, who talk more or less nonsense about those industries because that's what they were taught to do in business school. What he was talking about in every instance with those investment examples was economies of scale, local monopolies in distribution, and exploiting them. When he talked about Nestle, what was the good example of investment in Nestle? It was the frozen food distribution for DiGiorno pizza. Why is that profitable for them? Because they have a huge frozen food distribution infrastructure with large economies of scale already in place, and it's an intelligent way to exploit it instead of deciding to develop a goddamn new brand. When he talked about Pernod Ricard, what was the example he talked about? It was taking Absolute Vodka, a terrible brand, and how was he going to make it successful? By putting it through a well-established local distribution infrastructure and advertising infrastructure with economies of scale. When he talked about Ambev, was he talking about developing new brands? What was he talking about? Given they've got economies of scale and distribution and nobody can compete, what does he want them to do? In Colombia in particular, raise the price, which is to exploit that distribution monopoly. And finally, when he talked about Heineken, what was he talking about doing? Developing new global brands? Don't be ridiculous. Raising prices in cooperation with the now smaller group of competitors with whom they share these economies of scale in distribution and not have to worry about potential entrants. So hopefully you have been taught to think in terms of these kinds of monopolies explicitly. But I think it ought to be significant to you that a great natural investor like Tom Russo with a hugely successful record may talk the stupidity of brands, but when push comes to shove, it's because he intuitively understands the economics of local distribution. Today you have, I'm going to do a very short introduction because you have a real privilege in Andy Weiss. This is inside information. First, Andy and I first started talking about investments in 1976 when you were nothing but glimmers in the eyes of your parents, if that. The striking thing about Andy is that he was smart before he was rich. It was absolutely clear at that time that he had the intelligence to do well, and you ought to be reassured that, in fact, the vehicle that he used for that was a value approach to investment. That's the first one. The second part is that by doing fairly offbeat, complicated things, he is the investor in this room with uniquely the best record that you will see. Since 1991, after fees, he's compounded at 19%. In that time, he has not had a single down year, including extraordinary performance over the last 2 years. So with that as introduction, pay attention, Andy. He used to screw up like that when he was in this class too.
Oh, did he? Okay, I'm very glad to be here. Everybody says that. I'm glad to be here because I view one of my main jobs now is hiring, and especially with hiring from interns. So I view this as sort of a recruiting opportunity. I'm actually going to split this talk into two parts. The first part is sort of why is value investing so difficult. And part of the motivation for the first part is something that Bruce said one of the times I spoke at the class, which to the students, which is, students sort of had said, well, how can all these people be such idiots who are not value investors? And Bruce said, in 3 years you're going to be just like that. Bruce is so nice. But you know, he's right in a sense. And you know, in a peculiar sense, you should be like them. You know, in a very peculiar sense. Because he's right that you will be like them. You're likely to be like them. And I'm going to tell you why. Because the culture, the zeitgeist, whatever the hell there is going to push you in that direction. And the reason you should be like them is that if you don't go to work for somebody like me, you will be very unhappy and probably get fired if you don't act in this stupid way. Because the culture is going to push you to be conventionally wrong rather than unconventionally right, to dance as long as the music is playing in the immortal words of Chuck Prince. And I want to sort of say, and also, by the way, the other thing is, you might very well be a happier person acting the other way. What we can teach you, what Bruce can teach you, you probably won't tell you this, is he can teach you, and I can probably teach you, how to make high risk-adjusted returns. We cannot teach you how to be happy. I'm serious. And it might be that the kinds of behavior that give you high risk-adjusted returns will make you miserable. What we tell our investors is, we stay up nights so you can sleep well. But it doesn't mean, you know, they might be better off. It's not clear that we're better off as the investors, because, you know, we're obsessed with risk and we do things that I'll explain to you later, make your life kind of unpleasant. Okay, so this talk, the beginning talk had this title. It also has a title, a different title, which I've sometimes used, which is Value Investing Where Mutants Thrive. And anybody knowing Bruce knows what that means.
You just called me a mutant.
Okay, but Bruce is one of my closest, dearest friends, and actually, Bruce was wrong when he said that I'm the best investor that will talk in front of this class. Bruce is the best investor that will ever talk in front of this class. Bruce is the best investor I know. Okay. Is this going to work? One of these buttons might work.
Should be the left. This way.
Oh, there. Okay. So this is what I began with. So you have, this is popular stocks, and this is the experts. These are the people who are doing value investing. It's not only hard and difficult, but it's also pretty boring. You're not going around finding the next cure for cancer or, you know, going to wineries and drinking the wine or whatever the hell. So when you're reading balance sheets, you're reading documents, you're doing arithmetic, you're multiplying, you're adding, you're subtracting, and you don't like trust people. You don't like listen to stories, and you don't make friends with management and all that kind of stuff. So it's both very difficult and not a lot of fun. And if you look at the rules for daily life versus what you need to do for logical investing, it's very different. In daily life, there's a whole bunch of things that really work. You need to believe in yourself. Protect self-confidence. If you do that, in investing, it's not going to do you any good. Believing in yourself, projecting self-confidence is not going to move the market. Being charismatic is not going to move the screen. It just doesn't happen. In fact, what you need to do is to always doubt yourself and be insecure, because you might be wrong. And remember, whenever you buy something, someone else is selling it. So you might be making mistakes. So you're second-guessing yourself, trusting your gut instincts. There's a lot of evidence that gut instincts work very well in daily life. There is evidence that people who have damaged the emotional centers of their brains do very poorly on gambling games, on all kinds of decision processes. And your gut instinct really works. You know, in terms of you meet somebody and you're just feeling about it, cops going. But in investing, it doesn't work because the price already incorporates the gut instincts of everybody else. So what you have to be able to do is not just to have a good gut instinct, but that your gut instinct anticipates the gut instincts of other people. That's a very kind of strange notion. But we're used to relying on our gut instincts. What I do, by the way, is if I have a gut instinct to do something, I take it very seriously. I investigate the opposite. So if I'm sort of walking around and it sort of comes into my mind that you should buy A, then I look into shorting it. Or I think my gut instinct's no better than anybody else's. So everybody else is probably having that same thought. They're probably going out buying it because they're having that weird thought. So I'll short it. Or I'll look into shorting it. So it gives me ideas. My gut instinct gives me ideas to do the opposite. There's another part which is similar to the gut instinct, is avoiding empty restaurants. Buy things that are popular. Join the consensus. That really works in most of life. I mean, popular products are usually a good thing to buy. What your friends are buying is usually a good thing to buy. Popular stocks are not a particularly good thing to buy. If your friends have had a good experience with a product, you might want to buy it. If they've had a good experience having bought a particular stock, that doesn't mean anything. That's ancient history. But it's unnatural. Our natural instincts are, oh, my friend did well with Berkshire Hathaway or Microsoft, whatever, so maybe I should do it. That's very different from your friend having a good experience with a iPod. Buying Apple is very different from buying an iPod. And you have to sort of get your mindset around that. Another thing is the kind of a litmus test for soundness. In daily life, you don't want to have all these weird ideas because people think you're some kind of weirdo, right? But in investing, weird ideas pay off big time. I'll give a story. I was in the 1980s, around 82, I was at Club Med with my family. And there was a guy sitting at a table with his girlfriend. He was a very interesting guy. He was the head of corporate finance at one of the two largest investment banks. He was there for 2 weeks. The first week with his girlfriend. The second week, his girlfriend left and his family came. I thought that was pretty gutsy, actually. He didn't move. Like the kids came. So anyway, so he's sitting at the table and, saying, well, what are you guys, what's a good investment? And, people say, water treatment plants, desalination, waste treatment, strip malls. I say Mexican industrials. At that point, the Wall Street Journal had 6 consecutive articles about what a basket case Mexico was. But in one of the articles, it also mentioned that there was one department store company in Mexico that was selling for the value of one of its stores, and it had 6. So it was selling for 1/6 the value of the 6 department stores that it owned. It didn't seem so bad. So anyway, so I said Mexican Industrials. The next week, every time I see him, he goes like this. Mexican Industrials laughs. It's kind of embarrassing, you have to spend 2 weeks, a week with this guy, going, laughing at me every time I walk by. We made, Mexico, I was buying Mexico fund at the time at 2.5. We sold out at 30. 2 years later. I mean, it wasn't a bad investment, but it was an unpleasant vacation. So you have that cost. So like I said, you can make, and if you work for this guy, and he was really, he was head of, corporate finance at a very large investment bank, he probably would have gotten fired. He probably would have fired me. I probably couldn't work for anybody. I get amazed that Bruce can work for anybody.
I don't kidding.
Yeah, tenure there too. Yeah, tenure's a wonderful thing. So the other thing is, about sound is people want to buy sound stocks, linear stocks, kind of stocks like Pan Am, TWA, U.S. Steel, GM. Sound stocks will lose all your money, but maybe you won't lose your job. As opposed to these kind of weird stocks like Google or something like that. So we buy stocks that are, like Bruce described it, sick but not terminally ill. Because they can be cheap. You want to buy things that are really cheap. So again, if you look at what happens in the world, you want relationships. That doesn't really help you a lot in investing. The group loyalty, the consensus, all that kind of stuff. I like this cartoon. So to succeed, you have to wear the saxophone in the hat. We're not doing that. There's a guy over there, nerd, geeks. But you're not part of a team. I'm on the board of a charity. They accused me of not being a team player. I thought that was a compliment. They thought it was an insult. So if you're going to be a team player, what we're teaching you, you should be teaching you, is in some sense not to be a team player. In fact, in my firm, we have a slogan, which is, we need follow or get in the way. We have all these slogans. That's one of the slogans. We want people who are oppositional. We want people, we have another slogan, don't just do something, stand there. We want people who are going to go against the grain. But that's not easy to do. The other thing about the various slogans which makes it difficult, if you hear things on the radio constantly, you're getting bombarded by nonsense. Like, the market punishes greed. Or, now the market, it's a particular kind of religion that there's a market god out there who cares what Andrew Weiss paid for a stock and then he didn't sell it when it went up. Now, I don't know, maybe you believe in that kind of God. I'm not going to question your religious beliefs, but it is an odd belief to have in a pagan God who's that concerned about what I paid for a stock. And when it goes up, he's going to punish me for not selling it because I'm being greedy. Which it says you should take profit. That's kind of nonsense. The market doesn't care what you pay. And one of the things you should bear in mind is to, except for tax reasons, to try to purge your mind on what you paid for it, of your cost basis. Just worry about and that's not so easy to do, by the way. But we try to prevent anybody. They're not allowed to say to me what we paid for a stock, or what we could have bought, or anything about the past price history of the stock. So hopefully people will not think about it. But it's human nature, I guess, to think about it. So that's why it's unnatural, because you're going against your nature. This is another. This is in terms of don't just do something, stand there, which is all human errors are impatience, premature breaking off a methodical procedure. And that's not so easy to do, is to just grind it out. Okay. It's even worse, though, than daily life, because our evolutionary history has conditioned us to do things. There's a survival of the fittest, and one of the ways the gene pool was filtered is in ways that are dysfunctional for investing. The gene pool will be filtered to give you for an ability to recognize patterns. If you're a hunter-gatherer in a primitive society, it's very important to be able to recognize if the tide is coming in. If you're kind of gathering shellfish. And that's not so easy to do as someone if you ever sit at the beach to know just from looking at the waves for a few minutes whether the tide's coming in. You have to be able to filter out the pattern of the noise. But there is a real pattern to know if the weather's getting colder. And to sort of link up the fact that days getting shorter at first makes the weather get colder, but then it reverses itself in December. And the days start getting longer, but the weather continues to get colder. So to match up these patterns. So what happens is people start seeing patterns when they don't exist. So for example, we had some investment in the warrants of special purpose acquisition companies, and at one point the deal, I think 3 or 4 deals in a row voted down. So the price of the warrant plummeted. They thought all the deals would be voted down. The warrants were only worth something if the deals passed. So 4 deals were voted down. But what do you think, if you, out of 50 deals, what do you think the probability of getting 4 no votes in a row is going to be? Bruce?
116.
What?
116.
No, any 4. 4 in a row out of 50 votes.
No,
What do you think the chance is if you get 50, you flip a coin 50 times, what's the probability you get one run of 4 tails? It's 83%.
It's got to be very common.
It's 83%. So if you just flip, so those 4 in a row means nothing. But people don't realize that. If you ask people to flip coins versus make up succession of coin flips, if I ask about this half of the class to flip a coin 50 times and this have to make up coin flips, you will get many more runs on this half of the class than on this half. People don't realize that you get a lot of consecutive tails just by chance. They see patterns when they aren't there. And that's sort of ingrained in our nature. It's not so easy to get away from. And it's even worse, though, because even if the price patterns were real, then once people learn about them, they'll change their behavior, and they won't be real anymore. So even if technical analysis worked, and back testing is kind of a weird thing to do. Let's say you did somehow were able to do some out-of-sample simulations. For technical analysis, once everybody learned about it, it won't work anymore. So, which is not true of the tides. If we learn about the tides, they're not going to change their behavior. They tend to keep going in and out. They kind of don't care. So, again, in terms of evolution, past success is a good predictor of future success. You should follow the person who found the water hole last time. That doesn't work so well in investing because, in terms of who you should judge, because there's just so many investors out there. At 30,000, there's going to be somebody who's going to have, well, maybe not 19 up years in a row, but 8 or something. You're just going to get a lot of chance events. We're going to have a succession of good years. And you have to try and figure out if what they're doing is making sense, or whether they were just lucky. Whereas in a small group, it probably does make sense. The guy who found the water hole. And in evolution, all we have to go by is anecdotes, personal experience. Whereas for investing, you can use data to help, and it's not a great idea to look at. You look at the data and see that past performance does not predict that well unless they have very long histories. You just rely on data. This is uncertainty aversion, which is a little bit different from risk aversion. Uncertainty aversion has to do with when you don't know the risks. And it's why you hear often somebody will say, I don't invest when there's legal risk or when there's political risk. And because the risk is not quantifiable. I gave a talk at a friend's house. I almost never do this, but you asked me. And I gave the following example. How much would you pay you'd never earn with black and red balls in it? And how much would you pay if when you pull out the ball, you guess correctly, you get $10,000. And you get to choose whether it's red or black, which is winning. But I'm not going to tell you how many urns, whether there's more reds or more blacks or anything else. We did this in this class a while before, and people would pay much less than if they were told it was 50-50 reds and blacks, and they had to get red. This guy said he would pay nothing. But I can change that by having you let me get these things off for a second.
Yeah, if you go behind that screen, and you hit the, somebody's going to have to turn off the projector. Well, you should. Yeah, you should. And the chalk is on the side of the right there. It's in the side of the
So let's say that it's the percentage of X. Can people read this?
Yes.
Okay. It's fraction red. And remember what I'm saying. People pay much more if they know it's 50% red and 50% black than if they don't know the percentages. They pay, in this case, almost twice as much for 50 red and 50 black, and that's pretty typical. So the X is the fraction red. So you win if you get, if you guess right on red or black. So we don't know the fraction. But let's say, so now we're going to change the game a little bit. We're going to flip a coin. And I'm going to say, I'm going to flip a coin, and so I flip the coin and bet on red if heads, bet on black if tails. Now what's my payload? It's going to be, I flip a coin, well, half the time I'm going to get X times the winnings, right? Because half the time it's going to come up red, right? And red's the probability of it being red. X is the probability of being red, rather. W is W is the payoff. If you win. And then you get plus 1/2, you get 1 minus X. Half the time you flip the coin, it says it's black. And then if you're black, the probability of winning is 1 minus X, right? Times W. That's equal to 1/2 W. Which is the same if I have a 50-50 chance. The probability of winning is 1/2. Well, that's the same as if you knew it was half black and half gray. So I can buy this game from the guy from Fidelity, who was at the, there was literally a guy from Fidelity, who was there, who was willing to say he'd pay nothing for this game. So let's say he had that game. So I buy it from him for practically nothing. And now I add this coin flip to it and sell it to the other people who are willing to pay about 45% of W for this game. I make a lot of money. I mean, so you can buy lawsuits, for example, and you just randomize them whether you can back the defendant or the plaintiff do this coin flip kind of thing. On the plaintiffs and the defendant, so you just buy a lot of these urns, then you can do very well, because people don't like uncertainty or ambiguity aversion. So now we don't have any ambiguity. You notice? At first you'd say, why do I want to do this? I don't know how many reds there are. I don't know the probability. But you can get rid of that. Also, the other thing is there are no beliefs that you can possibly have that make this game worse than the game where it's 50-50. You have to believe it's either more reds or more blacks or the same number. There's another way to think about this whole problem. But people are very uncomfortable when they don't know the probabilities. And that's a profit opportunity for you. When other people aren't comfortable, you can make money. On the other hand, it'll make you very uncomfortable. But that's presumably what I get paid for, to be uncomfortable. So like I said, the uncertainty will avoid unquantifiable risks. Okay. Now the question is, like I said, why don't other people do what we do? Which is also why maybe you shouldn't do what we're teaching you to do. One of the reasons is that for most people it's not their money. I run a hedge fund, and also I have my own money invested in it, so it is our money. So we take the returns a lot more seriously because we get paid off not by funds under management, but by the returns. And that changes your behavior a lot. And the other side of the game of people who want to be sound because they want to get a lot of assets under management. This is an example of a high return investment that we made and one of the consequences. So this was something called Kazakhstan Investment Fund. And we bought that right after Russia defaulted on its domestic debt. Everybody hated Russia. They thought Kazakhstan was going to be the next Russia. People hated Kazakhstan. Kazakhstan Investment Fund was traded, we bought it between $2.80 and $3.20. It had $3.50 cash in a Hong Kong bank, in Hong Kong banks outside of Kazakhstan. It also had another dollar of liquid securities. It owned 17% of Almaty Power. It owned 49% of the largest cement plant in the world. It owned a refinery, a couple of hotels. So I was visiting the University of Chicago with my daughter when she was applying. While I was there, I went to talk to the investment manager. He said that there's no way he would invest with anybody who was investing in Kazakhstan. Too risky. But all the risk was upside risk. I mean, usually when you think about risk, you don't normally think about your risk of making a lot of money. That doesn't normally turn people off. You can't lose money, but you have the risk that you might actually make a lot of money. We made enormous amounts of money on this thing. Well, and the rate of return was almost infinite because we got the cash back practically immediately. So when you have a negative cost basis, it's a little hard to compute your expected return. This is the story, the Mexican industrial story. Again, although we had these high returns, during the late 90s, we actually underperformed the people who were doing NASDAQ. When we had the big tech bubble, we didn't participate in that at all. So that's a problem. And then, we buy all these things with really unfamiliar names that make people uncomfortable, like Kazakhstan, Vietnam, Ukraine. That's this ICP SEMF is a local fund in Pakistan. We bought, Romania, all kinds of weird places. People get uncomfortable with that. This is another part of it. I'd say, one of the things about value investment, although we have a lot of people in the workforce who are very tooled up and know a lot of math, a lot of it is not the math, the fancy math. A lot of it is just reading the documents carefully. I don't know, have you talked much about that, Bruce? Yes. Okay. We have all these guys with very, very extraordinarily strong math skills. I'd say the main thing they do is addition. Then they do some subtraction, multiplication, too. And that gets you very, very far. And just seeing what the actual documents say, as opposed to what the lawyers tell you are in them. The other advice I would give is don't trust the lawyers too much. Read the documents yourself. Most of you can know how to read. It's not a great skill. It's not like you're trying to do something hard like being a plumber. Fix a faucet. Just read it. Okay. I'll just get through this. We just give all this stuff to people. So this was an example of some investments that we also made. So I'm going to give a combination of stories and other. So we bought in 96 and 98, we bought Russia. Russia was selling, the entire Russian stock market was selling for less than the price of Home Depot, 2/3 in 96. Funds were at discounts. We bought a fund called First NIS. A lot of what we buy is funds because we can see, we can look through to see what they're really worth. You know, we're not doing growth and we're not doing much in the way of earnings like Bruce's. We're really doing asset plays, and funds help a lot on that. I mean, we do limited partnerships sometimes where we get streams of earnings, but we like to get assets that we can just count the value of. So they had fixed expiration dates. They owned domestic shares. Gas pump, for example, that were priced way below gas pumps, ADR, so we could short that. People hated it. This was the Kazakhstan thing. This was another example of something that's seen in various countries. Get through this. What? Oh, you want to see these things? Okay. So I'll give you examples of things we've done over the years. Yeah, okay. So this was the Kazakhstan thing I talked about. So we bought it for less than cash. We took a very big position. One of the reasons it was selling for less than cash is that there were these cash calls that were available, sort of like what you have with private equity deals, but we took over the fund and canceled the cash calls. We also don't double dip, so we have no incentive to take over the fund and divert the money to ourselves because any money we take we give to the investors. So we took it over, but instead of taking the bad deal, profiting personally from the bad deal, we just canceled all the cash calls and sold out the assets. Then we didn't. The previous manager was kind of really bad. He probably had a possibility of suing him. We also bought Vietnam fund for less than cash, and it was trading for about 30% of our valuation. Again, it was cheap partially because they were going on boards and taking big teams were going on board, a lot of self-dealing. We took them over and replaced management. And so we distributed the cash, sold the assets. A lot of people just didn't know what these things were worth. They owned the largest taxi company in Ho Chi Minh, in Vietnam, I guess. They owned a school, half of the Metropole Hotel in Hanoi, a water park, third interest in a water park, all this kind of stuff, and a lot of cash. So you have to look through and see what a lot of this is worth, what you're going to get for this stuff. This was a long-short arbitrage on Turkey, where we shorted the Turkey fund in the U.S. was selling at 75% premium, and we were buying Turkish growth fund in Luxembourg at 17% discount. We've done that with property funds recently. They're trading in the UK. So we buy the funds in the UK that investing in German real estate or Scandinavian real estate, and short the ones in Germany that are investing in Scandinavian, in the local real estate. Often there's a big disparity that the ones that in the UK that invest in foreign real estate might trade cheaper than the funds that the domestic people are paying for their own property. So we can arbitrage that. We arbitrage these were these Thai domestic shares that we arbitrage. This was a case where people didn't like it because you had to. This was very little liquidity. That's another thing we do. Is some people will say they don't want to buy things because you can't get enough volume, so you don't buy it. It doesn't pay to buy it. Let's try an experiment here.
Do you think we'll push it up?
Peter, it's only $20. How much is that going to change your net worth?
It's so easy to pick it up.
But it's not going to change it. It's going to have a trivial effect on your net worth, right? I mean, how many people here, when the next time somebody comes to this class and says we don't make small trades, drop it $20. I mean, when they say they don't make a small trade, they're talking about thousands of dollars that they don't pick up. I'm not so much a prima donna. I'll bend down to pick up $1,000. You know, if you pick them up often enough, the other thing they say, it doesn't matter. Well, McDonald's has done pretty well selling $1 hamburgers. It's got selling enough of them, right? You know, they don't wait around and say, "Oh, we'll sell a $500,000 hamburger." Wait for somebody to come in. So you can do, you just do it electronically and just churn out, not $20 bills or $100, $10,000 bills, $1,000 bills, and you just churn them out by buying them electronically. You just place the orders every day, and you can place them electronically. So we did all the trifunds, and we just did it. You just make lots and lots of trades. We will trade. I don't know how many trades we make. Well, we do. Let's put it this way. We average 40 corporate actions a week, 40 to 50 corporate actions a week. Well, times 2 for 2 funds, which would be almost 100. We probably make, probably average 500 trades a day, maybe more. We're picking up a lot of more than $20 bills. We're picking up a lot of $100, $1,000, a lot of them. And you can just do it. If you have everything set up and you know what things are really worth, just keep doing it. It is kind of value investing, and you can accumulate the positions a small bit at a time. We also think about economic fundamentals. So, for instance, when in 1989-90, Germany was selling at a premium of 50% or more than 50% premium. And the reason we're selling at a 50% premium is you had German reunification, and people said the German government was going to spend a lot of money on infrastructure development in East Germany. Well, we sort of think to myself, well, supposing the U.S. was going to merge with Mexico, and they were going to raise a lot of taxes so they could build a lot of roads in Mexico. We're going to make the Mexican peso convertible to the U.S. dollar at 6 times the current exchange rate. They're going to give all the Mexicans U.S. Social Security, U.S. Medicare, Medicaid. You go out and say, that's terrific. I'm going to really buy a lot of U.S. stocks. Not only that, but I'll pay a 50% premium for U.S. stocks because of this. So the German stock market remains, and you were paying a 50% premium for it. Well, look, building roads in East Germany was such a great idea. They could have built the roads in West Germany, where the companies actually were doing business. It was ridiculous. So we shorted that. We shorted Korea, which was another kind of ridiculous speculation at that time. Korea was trading close to 100% premium, and the Koreans were trying desperately to be able to take their money out of Korea so they could buy California real estate, which I didn't think was particularly cheap. In 1990, Korea was 100% premium. So a lot of these are just...
Can I just stop you there, Andy? Do people know what he means when he says Korea is at 100% premium?
Well, that meant the Korea fund was trading for about twice the value of the underlying assets. Publicly traded securities.
So there is a fund that buys Korean stocks, that you can buy stock. You can add up the value of the stock that the Korea fund owns. The total value of the Korea fund stock itself was twice, which is 100% above the value of the stock it owns. That's what he means by Korea's 100% premium.
Yeah, worth 100% premium. Germany, that's what I mean by Germany trading at a 50% plus premium. It was trading, in other words, the package of German stocks was trading for 50% more than what was in the package, and it had fees. the package of Korean stocks were trading for more than 100%. That was also true for Spain. There was a bunch of fun at that time. People were just excited about foreign stocks. So these were other ridiculous stocks bubbles. In 1997, 2000, it was kind of weird. A foreign company, their U.S. shares were trading, the ADRs were trading at a huge premium to their domestics. You would love tech stocks. Oh, wait, I'm going the wrong laptop. This is another thing you should be aware of, which is the winner's curse. Okay, on the handout, let me just talk about a couple
You want to tell them what the winner's curse is? In case
Oh.
they don't know?
a winner's curse. I'm sorry. Winner's curse is if you buy a stock, or if you bid for something, there's one thing you know for sure. There's two things you know when you buy a stock on the open market. One thing is that you know for absolute certain that nobody is willing to pay as much as you're willing to pay, or more than you're willing to pay. The first thing you know. The second thing you know is that the seller probably thinks it's worth less than the price. So you have winner's curse. So you have to be very, very careful when you trade it. It's different from buying a regular product. If you go to buy an apple, cucumber or apple in the store, you don't really think, oh, why is it still on the shelf? Somebody must think it's overpriced. Well, the grocery store thinks it's, why is he willing to sell it to me? He must think it's, overpriced. But when you're buying stocks, you should really think that way. That you're getting hit with winner's curse. That's the one thing you know for sure, that you're willing to pay more than everybody else. And that's a very humbling experience, or should be. Very humbling for you. So you should think very carefully about why won't somebody else pay what I'm willing to pay when you buy stock. We think about that a lot. I'll give you an example. Something just happened. Maybe we can discuss this, because I don't know what to make of this. Okay. This is a company. I can give the name, but I don't know what that is. This is a company called QXM. It sells mobile phones, sort of hideous mobile phones in China. I mean, they have like glitter and gold. They really are. But they seem to sell quite a bit of it. It's trading. It has a $4.50 cash, and it's trading for about $2.50. The CEO, we talked to the chairman of the board, who's the sort of uneducated son of the guy who owns a lot of stock. He doesn't seem to know what the company does. Somebody wants to borrow our stock for short. Now, this is not a big secret that it's selling for $2.50, and they have $4.50 of cash, roughly. What do you do? This is a real question, because I'm not quite sure what to do about this. But it's a huge winner's curse. If they're willing to pay us, the brokerage firms are willing to pay us 12% per annum to allow them to borrow a stock, which means the guy who's shorting is probably paying about 20. They're probably charging 20 if they're willing to pay us 12. Just as an offer. I mean, this is without us negotiating. They just offer. They said, listen, if you let us borrow your stock, we'll pay you 12. So we could probably get 15 for lending out our stock. Why is somebody wanting to short a company that's trading for $2.50 when they have $4.50 of cash? Yeah. Maybe. It might be. Maybe the cash isn't really there. I mean, that's a real possibility that maybe it's a fraud. I mean, we're investigating to see if maybe they're just cooking the books. Or maybe they might be that they plan to never distribute this cash.
do you take comfort in the idea that no one thinks that that stock is worth less than that guy does?
I never take comfort in anything. I worry. No, I don't take comfort. I just don't take comfort in anything. That's, yeah. At least on the investing part. I get very nervous. I mean, people who short usually are not like, oh, they're not just waking up and saying, oh, I think I would have just short the stock today. Just randomly, the way they think. You know, oh, they hear a hot news story, so they think they're going to buy a stock. Especially a stock that's selling for less than cash. On the other hand, it's a little tricky to sell a stock. You know, if you want to sell a stock when it's trading, let's say we investigate and the cash is really there, which we're doing. So let's imagine the cash is truly there. But the management owns 55% of the company. Maybe they'll never distribute the cash. The manager owns 55%. So this is an example, let's say, of winner's curse. There is somebody who's willing to pay a lot of money to sell the stock at the current market price. So they pay a big fee to sell the stock. Now, holding it is kind of, for us, holding it, buying it, selling it, all the same. That's the other thing. People say the sell decision is harder than the buy decision. I don't understand that. They're all the same decision. The hold, buy, sell, it's all the same, except for transaction costs and taxes. It all has to do with whether it's worth more than the price, or whether you could have a better use of the money than where you're putting it. So there's a case in which you get, at least this is quite unique for us, actually. We haven't seen anything quite like this. So we're going to, we've sent actually people over to look at it, to research it, and to talk to management and everything. Seems like, so hard to tell what to measure. Okay. I gave in a handout, I gave an example, a technical example of these ups and downs. This is where the math actually helps, is on ups and downs. We call them ups and downs. These were kind of funny kind of securities. Basically what happened is if oil prices went, the ups plus the downs together will work the price of oil. There's a 3 times thing to get that. That's just a normalization. So the ups plus the downs are worth the price of oil. Really 3 ups and 3 downs. And if oil traded, the downs were, you made money if oil fell on the downs, the typical downs. And you made money if the ups went up, if oil prices went up. Now the downs sold for more than, if the company had liquidated in a moment, you would have lost money on the downs and made money on the ups. The two had to add up to the price of oil to create and destroy them. So the two as a pair had to add up to the price of oil. There's kind of a logical reason as to why the downs should trade at a premium. First of all, it's hard to short. A lot of you can't short stock. And this was you buying it down, so you're in effect shorting oil. So you get the advantage of being able to short. And if you short a stock or short futures, it's treated as ordinary income. By doing it this way, you actually would get long-term capital gains holding down for a long time. So anyway, the down was overpriced relative to fundamentals, and the ups were underpriced. There was, if you did a 20-year life, but if oil traded above 111 for 3 consecutive days, the thing wound up. But it wound up at the end of the quarter, and the most you could make on the ups was 120, because at $120 a barrel, the downs were worthless. So the maximum gain you could make on the ups was a little bit complicated. You had to think, what's the probability of it trading above 111 for 3 consecutive days. Conditional on that, what's the probability of it, what's the expected price when it liquidates, given that you can't do better than 120. If it doesn't trade above, what do you think the two things are going to trade for 2 years from next year, or when you come out of the position? What do you think you're going to be worth? So we simulated this, we ran a whole lot of scenarios, and we did actually very well on that. Oil did break 111 for 3 days when we got out of it. But this was a way in which you just did a lot of work. Although the catalyst, Bruce talks about catalyst, you can see the valuation. Anybody can see that the ups were cheap and the downs were expensive. The question is, what about the catalyst, which would be oil breaking, staying above 111 for 3 consecutive days. That was the catalyst. And then trying to figure out the returns. And then what do you think the return would be if you didn't do that? So that's kind of just a sense of hard work in trying to see how you can crank things out. Another kind of value investment we made. And by the way, when Bruce is talking about these returns, for the last, since March of 93, we've been everything neutral, market neutral, currency neutral. We're a hedge fund in the sense that we really do hedge. We're neutral on everything that we can think of. Markets, currencies, term structure of interest rates, sectors. We're doing, and I'll give you, so we're doing real arbitrage. Another investment that we looked at was remember I was telling you about Russia. So we owned this company in Russia called First NIS, which we bought in 96 and just generated enormous returns. We bought it in 96 when Yeltsin was running behind the communists in the polls. Even though it I think got really bad in 98, we bought it so cheaply in 96, and we still made this huge return. Just kept paying out money. Part of it is that the guy who ran First NIS, a guy named Mike Cowley, was thoughtful enough to hire as one of his senior executives an ex-general in the KGB, which gave a lot of protection when being taken over. So he didn't have to hire the mafia. He didn't have to hire them outside. Then inside. Anyway, so if you look at, so we ended up with First NIS. First NIS started selling all its assets and liquidating, and making these huge distributions all the time. Part of the reason, the other thing that was great about First NIS is he only got paid on distributions. When the markets crashed, he wrote the assets down to zero. Now, I don't usually believe in technical analysis and price supports and stuff, but I do think there's a very strong price support level at zero. Most stocks have a lot of, look at any kind of trends, a lot of price support at zero. So zero is kind of a nice number because he's marking his asset, the stocks he owned. He owned securities that were being valued at zero. They were illiquid. So he made a lot of distributions. Then it was left with a company called Burn Energy. Burn Energy had started out as a Caspian Sea company, doing oil exploration in the Caspian Sea. Then they bought Volga Transport, which was a oil transport company on the Volga River. Then they got out of all of that, and they got an interest in basically a 50% interest in the Bundy oil field in the West Congo. Well, why would you want to own the Bundy oil field in the West Congo? It seems kind of crazy, right? Well, there was another company called Morel & Prom, which has become a much bigger company. They also had one asset, an interest in the Bundy oil field in the Congo. That was their only asset, both companies. Burn also owned some gas fields in Tajikistan, but they won't work very much. What's interesting is that Morel & Prom was reporting that there was twice as much oil in this oil field as Burn said was in the oil field. and there was going to be an appraisal of the oil field. Well, I don't care how much oil there is in the field. There is an amount of oil in that field. So if you're short Morel and Prom and buy Burn, or buy First NIS, which gives you Burn at a 20% discount, because they're also marketing it, because it was trading at 20% below the value of Burn. So you can find Burn at a 20% discount. And it's claiming there's only half as much oil as what Morel and Prom says. And you wait for the oil appraisal to come through, the whole thing kind of collapses. So if you read the documents carefully, you can find things like this, where you find it's the same asset. Now you can say, no, why would I want to buy West Congo oil field? But this is like our, red and black gold. You win if it's red and if it's black. Because you buy both. In other words, either they expropriate the oil field, in which case you make a fortune on your short, or the oil comes in which you make a lot on your long, or you converge, whatever happens. As long as the two prices converge, you do very well. So you can eliminate the uncertainty version. People don't, first of all, it's a little tricky to see that a UK traded fund that invests in foreign energy that's invested in Bundy is offset by a French trade, a Paris trade company. So you have to sort of match everything up. So but you can look at these various kinds of stories to see how you can get investment opportunities out of this. Okay, why don't I stop and open up the questions?
Okay, I have, yes, let me just start with Matthew Cummings.
Yep. Notice that according to Capital XP, one of the largest holdings is UNG, natural gas ECM.
Yeah.
I was wondering if you could talk a little bit about why it's such a concentrated position and what the...
Well, we're out of it now. We've gotten out of it almost completely. The reason we were in UNG is, so this is over. So we're out of it. We've been out of it quite a while. What happened was, UNG is, it owns oil fields. It owns natural gas futures. And the government had said at some point they were going to limit the amount of natural gas futures that anybody could own. Now they own natural gas futures. You can. It's a little complicated. You're going to need a second. Okay, let's go back to the image. You own natural gas futures. It's an exchange traded fund, and they own natural gas futures. You can create and destroy the futures in the old little setup. You could, if you could take futures to UNG and get shares of UNG in exchange for your futures, or you could take UNG shares, take it to the company, and get natural gas futures in exchange for UNG shares. They're convertible 1-to-1. That's typical. That's often the case on ETFs. They can cash in the underlying. They're like a closed-end fund, but they're convertible daily. So that was the story with it, and they traded very tight. What happened was UNG became very large, and the government said, in its infinite wisdom, that they didn't want any one company to own such a large percentage of natural gas futures. So in one-side conversion, UNG would not create new shares for UNG. They wouldn't buy for futures. They wouldn't allow you to take futures and create UNG shares. But they would allow you to take UNG shares and get futures out of them. So UNG theoretically could not, as long as this was the case, could not trade at a discount, because if the price of UNG was less than the price of the futures, you could buy UNG and convert them to the futures. But it could trade at a premium, and the premium was unbounded. Because if the price of UNG was more than the futures, we could not take the futures to UNG and convert them into UNG shares. So UNG would not take futures anymore. So it was an asymmetric bet, and it was very liquid. So instead of holding cash, kind of held this time. So we just traded in and out of it. Because it was go to a premium. You couldn't go to a discount. If it was trading at par, you would buy it. If you needed cash, you could get out of it because you couldn't go to a discount. You would trade, especially during the course of the day, intraday, you would trade, say, sometimes we're trading like a 3 or 4% premium. So especially intraday, we would just trade in and out of it. It was asymmetric. That's not what you, I don't know if you would call that a value investment.
Yes, you do.
You would?
Of course.
Okay.
Listen, if you had a dollar bill that some days was worth $1 and some days was worth $1.04, and you could buy that bill for $1.
Okay, I'm just
Yeah, I don't know. I don't know. It's always worth $1.
No, I think it's a great investment. I'm just not sure you call it a value investment. I'm not sure because the true value in the dollar bill is $1. It wasn't like collectible, but for some reason.
No, but this is a $2 dollar bill. It's something you sell for $1.
Yeah, no, yeah, right, exactly. It was
You might not pick up the 20, but you pick up that dollar bill also.
We did. All during the day, we pick it up. All day, literally all day.
Okay, Kenneth, does that answer your question? Does Kenneth, Leslie also had a question about
It's
that?
irrelevant because you're trading in and out, right?
Well, sometimes we would hold. We might have held it for several days if it was,
If you look at a year
cash
chart,
or anything else. We modeled. We looked at the historic data on the volatility and where it was and everything else. So sometimes we would hold just quite a while. But sometimes we go in and out of it.
If you look at a year-long chart, nat gas has been pretty. I
Didn't
mean,
matter.
up and down,
We were short.
it's
Wait a
down
second. No, wait.
50%
Wait,
is a
wait,
consensus.
wait. We were always neutral on gas. So we were constantly, if we ever bought UNG, we would short the futures. Well, let me be clear about that. We never took a directional bet on natural gas. So the minute or the second we bought UNG, we shorted the futures. So we're constantly, I should mention that. We don't take directional. We're in the business of shooting fish in a barrel. It's not clear we're in the investing business. We don't take, we just like do this.
Okay, Kelvin. Go.
Yeah. So I saw that you had lots of positions in SPAC, SPACs.
SPACs, yeah, we're one of the biggest holders of SPACs in the
Can
country.
you talk a little bit more about that and what kind of role you play in the positions in
Yeah.
SPACs?
SPACs are called special purpose acquisition companies. Many people say that they're the same as a blank check company. A blank check company is you give people money. It's like, what was the South Seas Ventures where they say give you your money for investment to be determined later?
Yes.
So that was like the first of blank check company. So people called them blank check companies because you would give them the money and they would say they were going to make an investment. But they were very different from a typical blank check company. They had a very peculiar feature, which is that, so they were set up that way, and if you gave them the money, they gave you a share and a warrant. But they were very peculiar because they usually had a 2-year life. When they proposed a business combination, if you voted no and the business combination passed, you could get your proportional share of the cash. If enough people voted no, the proposal failed. Usually more than 20% asked for cash. Now we were buying these things, and the cash was invested in money market funds. And we had an arrangement with a banker. As we explained it, we spent a lot of time explaining this stuff to a bank. We had locked in credit and get 10 times leverage. We were buying these things for less than the cash. So 2 things could happen. They could vote, well, 3 things could happen. The deal could fail, and get our share of the cash and make money. The deal could pass, and we could vote for trust and make money. Or people could like the deal and bid up the price of the stock, and then we'd sell it to them and make money. And we're doing it with a lot of leverage. So it was just, a great part. And then later on, when these became really unpopular and everything got voted down, we started buying the warrants very cheaply. In fact, there was one warrant we bought for 5 cents and we sold for $1.20 because the deal passed. People thought no deal could ever pass. And we looked and figured out imagine how big incentive the deals in the past was. They only got paid. They got 20% of the deal. Not of the profit, but the deal passed. So they would also like buy our stock because they knew they had a pretty good idea when we would vote. The manager would buy our stock from us.
On that point, oftentimes after the deal passes, the stock goes to warrant, and won't trade right to intrinsic, or continue to trade a discount to intrinsic. Do you,
Well, who knows what the intrinsic is on the warrant?
after the deal passes, though?
The warrants have like this 2-year life. It's a warrant. I mean, this hugely very diluted with the. We never really worked with the warrant after the deal passed. Once the deal passed, we figured there were people who knew more about these companies than we did. There's too much winners first. Once a deal, in fact, even once a deal is proposed, we don't trade because too much winners first. And these very specialized companies, and somebody finds out a lot more about these companies than we did. So we stayed away from them once we were going to start getting hit with winners first. So we'd be buying the warrants pre-announcement, but certainly before the deal passed.
Okay, Ofer Harda.
So I look at your portfolio, it seems like you invest in ETFs and mutual funds, and I was just wondering, does it make it harder for you to outperform the market if you invest in
We're hedged. It's impossible for us. Well, we don't care.
So when you invest in index funds in Asia, what are you doing?
We're shorting the futures in Asia, the domestic futures. So when we buy these ETFs, we don't have any net exposure. So let's say we buy the ETF in Asia. We buy the ETF in the U.S. on some Asian stock market.
So you can,
What?
excuse me, you buy it on the Indian side.
No. We buy an ETF that trades in the U.S.
Right.
That's invested, say, in Hong Kong. It's on the FX side. So we buy that. Then we short that. And we do it based on what we think. We forecast what we think the Hong Kong market will open at the next day. So the question is, we try to estimate if this is trading at a premium or a discount, because Hong Kong isn't trading when we buy it. So we buy it, and we hedge, we short, let's say we're buying FXI. We look at the delta of FXI for the S&P, the Nikkei, and so we hedge as much as we can overnight. And then when Hong Kong opens, we hedge. We're basically trying to guess or estimate, I mean, fancy was estimate, I would guess, what the underlyings are worth, what the futures are going to be worth. And then you can, again, you can switch it, you can game it. So we're buying it we're either shorting it if it's trading for more than the underlying value, or buying it if it's trading for less. In fact, when people say that value investing means you don't short, I disagree. I was going to say that ridiculous, but silly. You can imagine I said that. Because what's the difference between shorting it if it's trading for more than the underlying value, or buying it if it's trading for less? I don't understand the difference between one and the other when I'm wanting to trade. And you find out when the market opens. By the way, if you look at our posted returns, our post up, it's very misleading on what we post. Because so much of what we do in the U.S. is offset by something we're doing in foreign markets that doesn't appear. So like all those ETFs and stuff is all, or the futures, or we're using puts. So you're only seeing half of what we own. And plus the fact is most of our trades are non-U.S. So, plus the fact that if we really had to disclose it, we wouldn't do it all together. because there's too many people that follow what we do.
Okay, Justin, you want to answer your own question? And his question is, why is there such a strong emphasis on India compared to other emerging markets?
There's no emphasis on India.
Is
We're
that it,
neutral.
Justin, where are you?
We're neutral. We're just,
Because the arbitrage opportunities in India are better than other places.
when we did that announcement,
ETF.
when we did that announcement, and we have like a Mauritius, in fact, we might get out of India because we can change the tax law, so we set up an entity in Mauritius to help us do India domestically. But you don't see, even there, we're just buying it through our Mauritius entity, which is buying in India, we're selling in India. I don't even know if we, when you say we have so much in India, I don't even know if we were long or short from this. I literally don't know. I also don't care, because we're offsetting it all. We're neutral.
Okay, Eric Delamarter, you want to go ahead?
Sure. When you get involved with these ETFs, or rather closed-end funds, how do you avoid driving the price up close to the NAV when yet still build a position that enables you to...
We buy a lot of them, and we're careful on how we buy. You know, we're very careful. We have a lot of programs. The traders we spend a lot of time thinking about where to be in the order book and how to not have price impact. One of the ways we do it is we try not to, to the extent possible, not to disclose that we're doing it. I mean, our worst problem is that once we announce, a lot of people start following what we do. But not a lot, but you can see there are people who just watch what we do. So it's hard. Part of it is there are thousands, hundreds, not thousands of funds around the world. They're doing the whole world. So, that also helps. So we're doing, every country you can think of, we're doing funds in all those countries. And we do small amounts.
Now I'll do Eric's real test. Your fund has positions in a number of large banks. From a fundamental perspective, how do you get comfortable with the loan books of these types of companies, and how much of your investment is predicated on that?
That's somebody else. That's not us. That's not us. Yes. In other words, there's something called George Wise has funds, and they get us mixed up with him all the time. We got this. What happens? It's really weird. People ask me all the time about why I have a big position in such a security. It's not us.
Okay, Ryan, do you want to ask yours? Because it's probably a good thing to do at this point. Ryan Orton?
Yeah, on your website you mentioned your preference for hiring people that you like to train them yourself, as opposed to hiring people who are already trained. Can you elaborate a little further, talk about
if they work elsewhere, they might have learned something. So now we have a problem. They learned something after unlearn it. I mean, if you learned what Bruce, not everybody is privileged enough to be able to learn from Bruce. If they go to a different firm, then they go learn all these things that I have to unteach them. So that's a big problem. I'd rather have people who I can teach from scratch than if they've learned a lot of stuff that, and I might not even know what they've learned that's wrong. I'd much rather start with a clean slate.
what specifically are you teaching them that people who don't have the opportunity to be trained by your
Bruce? Teach them what Bruce teaches you guys. Probably.
No DCFs. Why are you on the right side of this trade? What is the disease of this stock and why is it not turning? Is that what they call it in corporate finance? Okay.
Yeah, I mean, why, those kinds of things. Why is this an opportunity? To just think very methodically about companies and not to worry that all your friends and relatives and in-laws think you're nuts. And you'll never get that. When you have to work for me for a while, you'll be unemployable by most of these big firms. Because you'll have, really weird ideas like to buy sick but not terminal companies, or that shorting is the same as going long, selling is the same. Basically, what we teach them is everything is a homework problem. Just to think about every investment decision as if it's a big homework problem. And also, we teach them also to be very confrontational. To me and everybody. So, everybody says it's not high Wall Street, but we really are. Nobody has a private office, including me.
Andy, let me ask you a question, because I think it's how do you find these ideas? How do you find
in the old days, I found the ideas. And I have no idea. It's sort of like when I did research with, I did economic theory. And how did I come up with the ideas? And how come other people did? Or if you look at mathematicians, how did they come up with the ideas? How did they ever invent something new? These are questions that have been around for hundreds of years. So it's a little hard to know how you come up with ideas. You read very widely. You look for things that don't make sense, like Germany thing, or when I talked about the Philippines, I did one of my first talks here. We talked the Philippines. It was trading pretty cheap, but there was no electricity, and they had gas generators on ships in the harbor. So that's kind of, you sort of think, hey, things might be really cheap there. Or you look at Mexico, having all those stuff with these big discounts. Now what we do is we actually have meetings of value, investment meetings where people come up with ideas. Some of it actually comes from brokers. Out of about 100 things the brokers Joe asked about, one of them it works out well. About 40% of that is also doing the opposite of what they suggest. About 60% is what they suggest. Because if they suggest it, there's like something going on there. And I think they're right. 99% of what they suggest, we just forget about it. But some of them, are worth investigating, either going in their direction or the opposite direction. To find things like that, reading the documents. We look for things that we kind of also stick to our area of expertise. We don't do stories. We don't evaluate management. We look for things that are difficult to value, difficult or difficult to trade, but they can be valued. Hard to value, but possible to value. Hard to trade, but possible to trade.
Okay, last two questions, and I'll let Letitia Bethel and Matthew Gordon. Letitia here?
Here.
Go ahead.
So my question was, reading your bio, you have a strong academic background in economics. So my question was, how does this influence your investment strategy?
Completely.
And influences you and differentiates you from other investors?
I think my well, it's hard to tell whether or not my personality gave me the academic background. The academic background did it. But first of all, I was doing economic theory, which means that we were doing things that was contrary to what other people are doing. Because if you're doing original work, it's only original if everybody else thinks from the opposite. So I'm sort of used to being kind of contrarian in that. The academic research gives you a lot of discipline, self-discipline, on thinking hard. Being at seminars with people like Bruce or Joe, or people who will challenge you, or some really smart people, it gives you a lot of insecurity, which is really good. So you don't have a lot of hubris. You get the seminar and people like attack you, and that's good. So it kills your hubris, and you have this kind of disciplined way of thinking about problems. So I think it was really essential. I think it had a huge impact, and then it helps in some other ways. Like people take my phone calls because people, they sign my papers, they read my papers in graduate school, stuff like that. So that helps some too. But I think it's a huge payroll.
Matthew Gordon.
I think my question was answered. I was wondering about some of the smaller positions, but I have another question. Are you finding any opportunities in Greece?
No. We haven't looked really. We did look a while ago with Greece. We got Cyprus with there. So we looked at, that was kind of an interesting case with people who came up with Greece and Cyprus. And I do some of the override the employees. So they like Greece, I like Cyprus. So we did Cyprus and not Greece. We don't see, it's not a shooting fish, not enough of a sure thing, I guess. I mean, I think one
No, but
advantage,
can I
I think
stop
one
you,
negative.
but let me just, obviously they looked at Greece. Because at the moment, Greece is a piece of crap, and that's what you're interested in. And obviously we looked at Greece at First Eagle, and it's just not that cheap for the piece of crap it is. And you see that right away. So sometimes pieces of crap are pieces of crap. They're worth buying.
Yeah.
So, but Greece is something you're going to look at.
You know, we'll look at all kinds of weird things.
The reason I actually asked Matthew to do it is that I'll read the prior question I got. I noticed the biography of your website mentions you spent time at Bell Laboratories. One of my favorite investing books is by William Poundstone. It tells the story about John Kelly built on Claude Shannon, Bell Lab's mathematician's information theory to develop the Kelly criteria. Do you ever use the Kelly criteria?
I don't even know what it is. I don't know what the Kelly criteria. What is it?
It's the optimal weight to allocate to any investment idea based on your confidence, assuming you know the odds.
Oh, I thought Andy was going to give a different answer. We were both at Bell Labs. The mathematicians are incredibly smart people at Bell Labs. They are incredibly stupid investors because when they go to invest, they decide it's a different game. And all that mathematical and logical skill doesn't apply. And it's a matter, the worst case I know of is a guy who listened to his dentist. So
There is a
I
guy who messes with one of the mathematicians.
right, but he was smart enough to do that, right?
He invests in one of the.
But when you talk to these other mathematicians and you talk to the physicists, so it's not enough, and that's the thought I want to end on, to have just a high IQ. You have to have the right set of Newton skills to look for the crap and buy it. Is that fair?
I think even I would say what Bruce said even stronger. There's the psychological and emotional component is the most important. You really need that ice water in your veins. Just to not care. And because we hired, as interns, we hired some, a whole bunch of people who were like gold medals in the math and physics Olympiad. We have literally never made any of them full-time workers out of 4 or 5. And these guys presumably are seriously smart. They gold medal. This is the top 5% of the people who get invited to the math Olympiad. From the whole world, the International Math Olympiad. But it's the kind of emotional fortitude, emotional psychological fortitude that you really need.
Andy, thank you very much. All of a sudden,
That's very
Oh, see, so that was signing up as a
I'm just not very good at judging. No, I have to say, very successful. I think it's more common to be just the pain to fail. They're pretty competitive. I don't care if they lose money. And that's the other thing. That's what they make mistakes. And I've done that's a problem. We don't have to deal in them. So I'm down. Not when you travel. How bad would it be? What's the change in returns versus the risk if you go tracking? We have two little tracks. Really good. And the problem is everyone's actually spoiled because they all work on hedging so well. And they work on spoiled and never have enough. I got to change that. As a change them, you don't take the taxes. You're, that's I got to change that. The first one is I'm almost done. And you get better returns. You might even have lower risk. You might get a downside. You can get a problem. It's just tracking it.
No tracking, you're tracking your exploitation. It's just like
the tracking is difference between the hedge and the underlying. The perfection, precision of the hedge.
Oh,
we spend too much. The hedges are too precise. Yeah, because it's too much. decisions ahead to get precisely right, prove up, tracking everything. It's so easy to do it, and everybody, enough of that. And then there's a lot of stuff in the game, you can't get precise. You just get the chance because it has so they can avoid things. You don't, 256 and that makes you nervous.
You call value. So yeah, because it's predictive. When you're dealing with the stacks, it's somewhat locked in.
Yeah, but it is kind of we have an estimate of the true value. They're hoping the next day is the true value. We're trying to think about it for the hidden markup process, where you see where it's possible. In other words, it's fuzzy as to what these things really work. That's what that means. In us, we have this is our close guys with the most value. I said, a really good idea of what it's worth. Not natural. If it trades, if you're doing a pancake with zero funds, it's not running zero out of zero that. We're doing based on the U.S. laws. We're estimating what a true value is.
So I have one.
Yeah.
There's a lot of spaces.
Not enough. The only goods we have we should have more. Because we need our further I mean, again, taxes is better. I mean, other people, I always wish that they make a course when you break out your segments. It's hard. I mean, it's hard to change. Just brainwashed them this way. Now we got like brainwashed.
Now they've been trained this way. You have to fix it.
Yeah, I have to fix it again too. I got spoiled. I try not to hire. I never hired anybody. Yeah, no. All the classical parents. So we never hired anybody. Closest thing. We did hire a chief external counsel. They did that. And then you'll see here he worked front end. So as a we don't like most of the people who are including that. I've told her, I've never seen them hire me. No, but most of the people who do, but they're all physics, not intense. Anybody.
Steal out, just say something. Otherwise,
It's just what you said about the selection bias. People want the same. You have to be contrarian as successful as you are. But people don't want that actually with a lot of the other firms. That's what I have a strong feeling.
And I'm not sure that you can be happy doing your part. I mean, like, I'm very serious. I wasn't just sarcastic.
Oh, I know.
I'm very serious about that. It's not that we can teach you. We can teach you how to make high risk adjustment trades. Not that teach you. we have to really consider that as opposed to
money is second place.
well, it's hard when you know.
But to your point, I was like, I got something when I started working at AutoZone.
Whereas before, there were guys.
You're going to be working with something that nobody's going to, they're all going to sort of look funny at you. They're not going to understand it.
How do you think it using it passes?
Right.
Oh, yeah.
Reaching a national level of prominence and making less than a secretary. You're on the periphery of society.
Right.
And you have to do it. You have to have a lot of conviction doing it when you're not getting paid.
So what they do?
I mean, part of it is you have to realize that sometimes you're not going to be able to keep pressure around to join them, so they're not going to
Okay,
be,
so let's do
so you are going to be on out for a while.
Let's see if we can do it
Yeah,
Thursday.
well, I feel
Because I got a meeting.
No, and to be honest with you, it's only because I've had these high returns for so long that I'm sort of socially acceptable. because I mean, I hadn't had, people like me, and people would think I was really great. It's just
But wait, you may see the back of the next door neighborhood. When you're in your shop.
Well,
a lot of color.
Everybody's always sees each other. Yeah, because I get to choose.
Exactly. So like you said, yes, your sluggers. We had our sluggers. Just like crazy. And inside, we were very happy. But we wore our store managers, store employees' clothing.
I just like this. I just like this.
Oh, absolutely.
Oh, yes, I have a college shirt. Yeah, in your shirt.
Sort of pulled out like you're trying to pay her less than
I had a grist today from my son.
Yeah.
Oh, congratulations.
maybe originally.
I'm second.
Okay, good.
So,
We need somebody to
pulled out.
talk to Siri. I talked to Siri.
Justin and Paul.
Physically said, these people might be the stupidest people I've ever seen. And the combination, stupidity times arrogance, was probably the hardest biggest I've ever seen. This is this German property. These are people who this is amazing. They did renovations renovate property, rich commercial in the late 90s, early 2000s. They think they're geniuses because they made a lot of money. They had no idea what they were making with war. They did nothing. So now they can take the same art into Germany. And these people, I mean, whether they were a combination of arrogance and stupidity. Well, they stopped it by trading. 500 million euros of property. It's trading for buy the stock for $28 million. What's the numbers? They have unencumbered assets that worth 42 million euros.
Hey, listen, I've got to go upstairs and give her a book. Give her a book. And then I'll be back down.
That sounds good.
I mean, I got physically sick. This was the worst, one of the worst meetings I've ever been in.
Yeah, they're not.
They don't like these STC.
Well, yeah, you gotta get rid of them.
You made me executive chairman of Jimmy.
Yeah, you can shoot. You have it. No, you can.
Don't make this one of the ones that he decides to go over the weekend, okay?
No. All I can promise is we'll try to act rational. You know, you should have rationale.
Well, the animal rationale.
See if she laughs for us.
It's what you teach us every day.
My sister. So I don't know, but when I say we should make movements and trades, it might be the case that we have less downside risk if we have more diversified things with higher expected returns that are less likely, have more risk side.
I wouldn't change anything. It's obviously working for you. I wouldn't change anything. If it ain't broke, don't fix it.
Well,
It's your record.
I don't think you understand the whole.
He's got the same mentality, but what he's picking has changed a lot. He's opportunistic.
Well, ask him where he's been when he was 2 years.
I know that answer. I think.
I mean, since you were with
Well,
me,
you
like,
have Tom Bruce.
You started with a macroeconomic model.
it was long only emerging markets.
Exactly.
And it was heavily Russia, and then it was heavily Czech, it was heavily Czech, it was heavily Russia. At one point it was heavily Thailand. We had a lot of Eastern Europe, we did a lot in Poland, we did a lot in Romania, then we did India for a long time, Pakistan. I have no idea.
No, nobody minds.
Yeah, I have no idea what the next one's going to be.
Well, we were talking about.
Could be.
Just because he looks at it once doesn't mean they don't go back and.
No, we keep track.
Right.
We got yeah, we have like this huge database and stuff. It's just, we don't know.
Your essential database is closed-ended.
I don't know, it's been broadly defined. I mean, the SPACs were, the biggest, we had over $1 billion of SPACs at one time. We have all these ETFs, I think a lot closed-end. They really are closed-end. I think SPACs are like closed-end funds. We tried to do things we could value them. Yeah, they were all, in the new workbooks about value, strategy, asset base. Because we did a lot of property. Property, we did a lot of anything that's hard to value is kind of strategy. I don't know. Yeah, assets. Not stories, not growth. It's assets. It's almost always. I would say,
Those Walter Schloss.
yeah, exactly. Or it could, to some sense, reduce capital, capital for market structure all for like this thing with the one-sided bet. That's not really assets. That UNG.
Yeah.
That wasn't really assets. Bruce said it was value investing. I don't know if I would call that value investing.
Not really. There's no downside risk.
Yeah.
But there wasn't necessarily any upside.
Theory, this thing should never trade but you must there's going to be some fluctuations, and you knew it bounded. So I don't think I would. That was more of I would call that more of a market structure. I call that market structure. I did. It was kind of a market peculiarity. Yeah. Well, you have some ADRs that are one-way convertibles. There are other kinds of securities that are one-way convertibles. So you have like asymmetric structures. So you have things that trade in scary markets. There are a lot of things that have they're peculiar. The things we can understand. The things that I've explained to Peter, you would say, yeah, that's correct.
Yeah. There's a lot of mathematicians.
They're all in the firm.
No, he's
Well, we're really,
Yeah, we're in the firm.
we have skin in it. Very nasty.
It's fascinating. Anyway, thank you for your time.
I grew up questions.
I'm Steve. Steve. Well, you can hear me well.
Confidence around that information as
But I'm on exchange.
We assume everybody. I talk to people.
But in all the people I've met in high school, I'm the only one who's
I've been around
so
a lot.
Yeah,
So I know where
It's not around you see if things
to be consistent.
contacts.
But I always loved it. I used to see with my phones, my college, too stupid to know.
Send people. We try to align. Mostly
Yeah, well, that's why I went into the MBA. Whether they'll see the value of that.
We assume that they
It's a world that
That's the sickness position.
right.
interest. How big is the problem? Not the problem.
It's part of the reason we should be MBA is to get away from
Taking in their interest
the model is not economically viable. Instead of
idiots.
Very well.
That's why and that's what you got to do. It's no longer. That's why there is nothing more than big
resources in the work.
Du Bois, as 8 days ago, we had money slowing around.
You have men already in the can, which is supported by cardiac. Decades of states.
I live on 86.
So I did it on the borders 547.
All the way to the east. York Avenue.
Before I knew what borders 547.
In the old days,
Well, the first place I did all
part of the problem is one about, we don't about that many losing investors. One of the losing investors was the guy just lied to me very early on. Blatantly lied. And after that, I realized that I don't want to trust people. So they call him. I don't know. It's different. It's hard. It's interesting though, that you ran AutoZone very similar to the way I run my company, and then that we get along. There aren't that many companies that run like AutoZone, man. And there aren't even that many investment firms. Like I run, where I don't have a private office.
Yeah. That's what I mean. We're just sliding it in. But it's just like, yeah, anytime we had a meeting, there were 3 people that were in the meeting. We wanted to begin with the pledge. AutoZone is always for customer purpose. We know our partners and products. Our stores are right. We've got best merchandise, right products.
I know that sounds
meeting. We define one of the guys and say, yeah, man, I think the right price. It's not the right merchandise. And again, the only way you try to end is to give it. Is to keep people making stupid mistakes. So you're going to tell me I was stupid before the marketplace fell.
That's why it's interesting. That's the same either.
The same thing. We just had a whole bunch of things like stop 30-30, drop whatever you do. Having your hands stop what you're doing to take care of customers before it's 30 seconds in the store.
My solution is to
Oh, no, it was. I noticed it actually when I went to I shot people. Yeah, now that you mention it. I was kind of surprised that I was just a good salesperson.
No, I mean, check, most of them will have a gazillion pins on their collar. It's just like, you did this or you did that, like,
That's really expert manager, biggest creator. I know that.
A lot of people say they don't like it, but they still like it.
Of course they're right.
But even
I'm
then,
really not good at that.
but I bet you won't because we don't stop.
Yeah, thank you. But I don't I know that. And it also permeates the culture, and I tell everybody, all the other managers, not to be like that. To do wonderful.
So what I was going to say is wonderful generally was if I wasn't getting yelled at, that was wonderful.
Yeah, I know, that's what it is. But I don't do that well. I have to, and I actually try, I push the pitch 800 on the radio to do wonderful.
Actually, because my right-hand guy was wonderful. He was out in the stores. He was I had bar was just merciless. But he had such high standards. Whenever anybody, when he wasn't getting spelled, they knew they were,
But I think it's very good. I think praise. This is the Jews I say. No, I'm not. Believe me, I'm not. That's not a problem.
We're not giving you praise.
You knew it was well deserved. That's not. We don't have that. We're not. We don't have that.
No great piece of Persian.
Yeah, we don't have any grades, but I don't think we do.
Okay, so Andy, what's on the agenda now?
She's going to tell us
Governor
time
Lawson.
limit.
Yeah.
Papers.
We just had their quiz today.
I was invited.
Big deal.
But actually don't invite others.
Are these employees or investors?
The investors.
Investors, oh, okay. Smart guys.
They are real.
By the way, did you send out the K-1s yet?
Oh, it's come out like very soon. I don't know.
Another investor.
Another investor.
Yes.
How long have you been investing in?
I don't know, when was it? Not long enough.
Not long enough.
And not enough and not long enough.
You mentioned First Eagle.
Yes,
What's your association?
I'm the director of research.
Oh, really? Yeah. That's Arnold Schroeder's.
It's, yeah, which is now, they sold an Arnold and Vice Schroeder name. Do you know them?
I have a friend who runs their arbitrage fund. He
Who's
went
that?
here, Jonathan Spitzer.
Oh, okay.
You know him, he was a student here.
Yeah, of course. So I'll watch what I say since you haven't said it.
So how's First Eagle doing?
We would do a lot better if they fire everybody else and just have him.
No,
That's a
we
place.
did very well in the downturn.
You they would do
Comparatively.
because you were there, no employees but you.
You had some gold.
No, it's not clear, because the thing is that it's a huge fund of 100 positions.
Yeah.
And you gotta have somebody.
We have 1,000.
I know. You could not run it all yourself. Right.
I'm a kind of spiritual guy.
Okay, so we're not in the same place where we're ready to have you just give spiritual.
Let's say they move down. Do they have a lot of gold?
Yeah, we have a lot of gold, we have a fair amount of cash, some government bonds. So we were, when the market was down, we were down 21. When the MSCI and other value funds were down 42%. And then we slightly underperformed last year for the same reason.
If I were a student, I would have raised my hand at one time because we were signing mathematicians, and of course the quants, your quants. What about James Simon?
No, that's not the point. The point is that there are mathematicians and economists who are good investors, who are smart. But the average mathematician, because he has a high IQ, is not a good investor. Jim Simons is exceptional. How many other mathematicians do you know have done as well as him?
How many mathematicians who are smart as him who invest?
Oh, but look, Ron Graham used to want to talk about stocks from time to time. Ron Graham's probably a better mathematician than Jim Simons.
People think very hard.
No, but the thing is, in mathematics, his reputation is not as high as it is in investing. And he's the exception. What I was saying I felt was quite clear, which is he was trying to say, associated with all these smart people in the high IQ sense of Bell Labs help you become a better investor. And the answer is in general, no, because they're not good investors.
The way you help you become a better investor is in the sense of when you come up with something, having people poke holes in it, getting rid of some of your hubris.
Right,
I think that's where it helps.
But it's not, that's a meta benefit. That's not a direct benefit. They're not good investors, most of them, because they have all these instincts that Andy talked about.
Exactly.
And when they decide to be investors, they throw out all the mathematical stuff. That's what I was trying to say.
No, but I think you do benefit.
You benefit from being around smart people. But there are a lot of people
who are confrontation.
Right.
Who don't suck up to you.
But being around smart people does not guarantee you to be a good investor. And being smart yourself is a long way. I'll tell you the greatest stupidity of my life that I ever heard from the smartest person. So when I was teaching Harvard, I was in this discussion group, and Ken Arrow was in there, and Stephen Weinberg was there. So Ken Arrow gave a talk on the impossibility, which is about the impossibility theory. It's about there's just no way of making group decisions that satisfy these 5 basic conditions that you think a good decision mechanism would satisfy. So he gives this talk, and I'm walking out with Stephen Weinberg, who's not just a Nobel Prize winner in physics, he's a great Nobel Prize winner in physics. And he turns to me and he says, he says,
I don't know what all the fuss is about making collective decisions. Why don't you just get the smartest people together, they'll figure out what's right, and they'll tell everybody else what to do. Guy's an idiot.
That's what Plato said.
That's, I know.
Yeah,
Well,
that's Plato wasn't an idiot.
Well, Plato said it in a very different way.
Well, but you want to boil it down to one sentence. That's close.
Close to
If
it.
you're going to give a one
But if you
sentence
actually
summary
read
of
Plato, Plato says many weird and strange things. And not appreciating and thinking that that's the way a collective decision-making process is ever going to work is a real failure of imagination. And this is a very strong point. And that's the point I was trying to make, that I thought Andy was going to make.
But you hire all of them petitions.
Yeah, but he doesn't hire all of them. He doesn't keep all of them. There is a small subset that are very hires.
And you said what interferes is their...
It's exactly what Andy talks about. Their natural tendencies to do things.
Just like me the same as everybody else.
Yeah, they just when in their investment they just act and they have all the weird prejudices.
So
that's right. Yeah, right.
Want to recap tomorrow? What time are we doing?
Tomorrow we've got a conference. We'll just call you on next week. Do that
Wait, Monday, my mother's coming in, so we'll be busy on Monday is a bit of a problem, and she's leaving Tuesday afternoon.
Tuesday and Wednesday.
Yeah, next Tuesday.
So let's meeting about 1 o'clock Tuesday.
He's also
coming back out.
Your mother.
So, okay. And then I have to be around because people have books on
But we can't.
No, that'll be fine. Tuesday
Yeah.
afternoon will be fine.
We have so many dialogues about it.
Right.
Yeah. Smart people, starting to act as business.
Yeah. I mean, look, you're welcome to try and sit in or seats you're welcome to stay. But typically, if you said they're not going to be. Oh, well, I get it signed. All right. Yeah. No, you bump into him.
I gave the guy a pass because he doesn't technically qualify, so he just doesn't have much to put in. But the other two, they have.
Yeah.
They're not really distributed.
But Andy's got at least his way of this year. Not with as much.
And he just needs to go.
Yeah, his period like that. And Steve can't go. Mutual admiration. In fact, when I was on the board of Kazakhstan Fund, we were getting the assets. And we bought some Kazakhstan fund stock and set for $1. All we wanted to make sure was that we could
Pay taxes, so you could do that announcement.
No, I think he's hiding behind the good. I'm not.
Okay.
But
That was put too much on the company. And then also the 20% loans and asset-backed loans just to run through.
Who is this?
Remember he said that, remember the first story he told about the finance
So doing the equipment loans on the equipment.
but, I mean, if you're lending, you're doing asset-backed loans to small businesses like that. $2-3 million loans, warrant stickers, those companies are in trouble.
Well, either that or they're not, if they're publicly listed, they should.
Yeah.
And what is the warrant ticker worth if they're not publicly
listed? Yeah.
So they are publicly listed. But he said they were getting 15-ish.
It sounds like 15-ish.
And it's,
And then the other thing is that the big thing is supposed to be a third is real
So what
estate.
the hell am I supposed to invest in? Everything
I hear you've got a good place to invest already.
I know, but I have to diversify.
I mean, why?
Yeah.
Sam Walton's always told me diversification, who needs it?
Well, because supposing I've missed something, supposing there's some huge fraud or something, I don't know.
That's your risk, is a huge fraud.
It's a fraud.
Right. That's your, is your diversified in your
I know, so that's the risk. That there's some huge fraud in my company.
And
Practice.
your underlings is
Yeah,
choosing.
practice.
Because if you're the one doing it, you're not going to lose money.
And then it'd have to be a wipeout, you know.
Well, I
somebody
think
stays
my
10%.
guess would be that if that's your fear, there are cheaper ways to protect yourself against that than being diversified into a bunch of substandard investments.
Yeah.
Like I would hire somebody to literally every month, if that's what you're doing, audit every trade and audit every security.
We're going to code.
He
have,
has,
like,
They've got some.
he's got a pretty good system.
Well, then the chance of
Yeah.
that happening is got to be because of me.
Yeah, that's
It's
probably
very it is.
close to, but not.
Oh, don't be an idiot. You just talked about that. It's all my money.
I mean, you know,
Okay,
you
okay.
heard his fears of guys coming in with guns and saying, why the money? Yeah. Okay. And you have a great big
You have every
security
penny
guard.
in the fund? You have, well, you have this house on.
Yeah, that's, I mean, that bill is.
Okay, so
He's
sell
got
out.
some minimal assets
Yeah,
outside
that
of the
just
fund.
have
So sell
two
it.
properties.
So sell those.
What?
So sell those.
I have those, yeah, I could sell those.
And it wouldn't change your life very much.
That's
So keep one, sell the other.
I have like two houses.
That are hugely.
So here's what he's really
Take
worried
5%
So here's what he's worried
of
about.
T-bills.
Some massive fraud is going to wipe out all the charities that are going to give money someday.
Yeah, right, that's right.
There's a guy that we work with, and he always jokes, he's like, oh, I don't care what they're doing with taxes. That doesn't cost me anything. That just costs me that school over there somewhere.
That's what, that's what
He is a fool, that man. If he lets the stuff, and he gives away the stuff in his estate. Because if he gives it away while he's still here,
Oh, I think he's got stuff
he
to
can
raise.
take, I mean, in the estate, he just doesn't pay taxes on it. If he gives it away today while he's alive, he gets to write off the
Right
value
off
of
the
it against
bat,
his
yeah,
other income.
exactly.
Somebody ought to teach that guy how to do tax planning. We're not going to have
I
anything
don't
in
think
our
he's-
estate.
Too much of that.
Oh, God.
I don't.
You're a good demonstrator.
I don't do anything.
You do it, as you know.
I just pay, basically take all my money,
So what's going to be,
just shovel it over.
so what's going to be the taxable income this year? How are we?
Well, we're not gonna make my call.
Yes. I mean, for 2009.
Oh, yeah.
No, it's high.
Very high.
So we're going to have to pay a lot of.
You're gonna have to pay a lot of tax. But in 2010,
This is
But, you say not gonna make much money, so what does it look like now to close every year? Single digit, double digit?
right
Or, I
now,
just got it, it's like 4.5 or 5.
no,
It's more? No, it was 1.5 last month.
it was
1.78
We have
last
one,
month.
no, we're probably, not very much.
No, but I mean, if you look at your investments now, what you're already into, you know, you and I talked about.
Yeah, I don't think,
before.
I think it's gonna do that great. Maybe 10% for the year.
Because I told my accountant, my
I don't
tax
think we're gonna
income
make, I don't think this is.
Tim would only be about 10%.
No,
How much were you
isn't it
looking
pretty
at?
much?
How
You were up
much?
like
26%, yeah, but how much of it is on the?
For you, since he doesn't
Very
charge
little.
the carry 30-some-odd%. But,
I think it's all short
Us
term
poor-
Doesn't it all? Doesn't all?
all construction.
It's all,
It's all ordinary.
Passive, passive.
Oh, Jesus.
So that's when you're going to tell them, oh no, I'm pretty sure it's all ordinary.
It's the tax.
So it's a problem.
oh,
It's a disaster.
So why don't you do something?
Well, I tried to talk to him about that.
This, right, you know, for
The fees ought to be lower on that because the taxes.
No, it's not just that. If you're a personal investor, what you do is you give your money and you don't touch it. And every year you go to tax it. So you do forced savings.
Yeah.
Which is not what you want to do. Or you don't want to.
You take the money out to pay the
Yeah,
tax?
no. Of course you don't take the money out. Because you don't just.
You didn't take the money from.
No, your ordinary
We look at
cash
this
flow.
No, that's what happened. It becomes a
Where am I
big part
supposed
of
to
my
get the money to
portfolio.
pay the tax?
Well, that's the issue. Talk to Andy.
No, but we do evaluate the investments on an after-tax basis to see.
Because that's what one of my wife's.
I don't
And if
know,
they
my
don't-
big mystery is why is it that my investors are almost overwhelmingly taxing it? Why don't tax exempt people invest in it? They don't.
Well,
Because I don't have enough tax exempt income to give you.
By the way, does anybody withdraw income from the You do? You do?
I-
Yeah, I guess.
I'm sure the ones who have all your money. Who have all
How else
your
am I going to pay my taxes?
Yeah, the way I like to do investing is you give them a sum of money, and it sits there. And every so often, the lender says, we want you to make the total X. And I dutifully write a check.
Do I say? But anyway, I'll leave on the, basically, I'm pretty much the only person who used to be at the club.
No, I'd be simply, in fact, I've been laughing at this for the last 2 years. I have a lot more disposable income, so I don't have tax laws. I don't have any taxes for stuff.
Please can any investors, small investors, have a little money? Not like this family partnership program, which is $250,000 maybe. $250 or something like that.
I have to track because I really it's happened before, and he said, that's not the way.
It's no big deal if you can't, but I'd like to get it here.
I just can't.
Listen, keep it to pay the taxes this year.
This is the second one.
He's learned.
Yeah, I learned that it was when I was in when back big enough to.
Wait, he'll open back.
So I would do I have to take money as
You have to have a steady income. You can accumulate money during the year. Because if what you do is, and we're finding this out, if you take all your excess money and invest it in these funds, and the policy is that you don't ever take it out, that you're a permanent investor, then you've got to pay your taxes every year. Right. And it just, sometimes it means you're less to invest. Don't disagree. You don't want to disagree. I just want you to listen.
He gives us the option. I like the way you do it. We have the option of taking the distribution. You don't force it on us.
Lee Lou, who runs, I'm not supposed to say this, Charlie Munger's money, in which I'm an investor, was, let's see, 2 years ago. And we started $2.5 million. By 2 years ago, after 4 years, it was probably $7 million. At the end of last year, it was $3.2 million. At the end of 08, it was $3.2 million. At the end of 09, it was over $10 million. And do you want to know what the tax bill is? And it's almost all long-term loans. $80,000. Pretty good. But it's been a ride.
I was going to say, losing 50 or 60% and then getting 3 times that back.
Is this a straight long portfolio?
Yeah. No, but I mean, and those are also the times you just don't want to, you can't. First of all, you shouldn't. And secondly, if you're going to trust these guys, you're going to never do that. Yeah, after that. But the nice thing about that is that the taxes are so small.
What do you think?
He does have
Why his taxes be so low?
because he's buy and hold.
His is all long-term gains, and his all gets counted as straight ordinary.
But notice that in 2008, you were up how much? 2%. He was down 7%.
But, so you're up roughly 30 net over the 2 years. So 7 would have gone to 9. So, question is, do you want to go 7, 3, 10? If I knew that's how it's going to happen, I like 7, 3, 10.
Yeah.
I probably was happy.
The big benefit from us is we could not have that return because there's no way to withdraw and there's taxes.
You have to withdraw.
It goes against your principles.
Our principle is never to withdraw money from it. Once it's saved, it's saved. Because we're supposed to live off.
Which they do. Right, see, that's it. I'll start withdrawing when it's my only source of income.
All right, so what is your schedule now?
I've been with you.
Okay. Now I have to. Do you have a car out front?
No, I'm parking on 116.
Oh, 116.
between Broadway and West End.
You know what, let's take a cab to your car. We'll drop you off at your car, then we'll go to the restaurant.
Why don't we just take the cab to the restaurant?
Okay, let's just take the cab.
I like that. See, she makes decisions.
Yeah, that was pretty smart. Okay, so we're going to go out through the...
I'm in the city, I
Through the
don't
back.
leave my car. Once I find a legal spot, unless,
Oh, I thought it was more. And you see, again, we have now that we've split it up into two courses. We have very different things for the two courses. So the first course is how to value companies, how to deal with businesses, how to understand real barriers to entry, earnings unpredictable. And it really is about the mechanics of doing this as well. And partly what I was talking about with Thomas and my understanding of what it does is that we really teach them everything. But, so that's the first course. And it's obviously useful for them to understand the stabilities of chromatography standards. But the second course is this is and it's really about our
And I had been playing quarterback contests and looking for it at that time. Back where the novel
Just like the one. Done west of the
That like he sits
Well, yeah, I think so. Yeah, for sure. Well, they certainly did the first semester. Yeah, the back-to-back classes for 1 week of the course.
guys. Nice work tonight. Yeah, I know.